2025 is going to change everything for investors. Are you going to take advantage of it? Here's what you need to know to do just that. Hey, my name is Shannon Rubnett, and welcome to the channel. In this video, I'm going to show you how in 2025 you can completely change your investment strategy. Whether you're a real estate veteran or just starting out, the market is about to throw some major curveballs, and the choices you make now could make or break your financial future. What if I told you the next few months you could be presented with one of the greatest opportunities or challenges of your investment career? Well, stick around, because by the end of this video, you'll know exactly how to leverage the Intelligent Investor Framework to stay ahead no matter what happens. You know, right now we're witnessing significant shifts in U.S. policies and global economic conditions with tariffs and other things that are going to change the game forever for investors. As we approach a trade war between the United States and its trading partners, tariffs are definitely coming into play, and we're seeing massive amounts of capital reinvest in the United States and commit to do so over the next couple of years. And I'm going to tell you why this is really important. But the consequences for the global economy are real, and there's something you need to be aware of. With inflation, changing in the market conditions, and the upcoming political landscape that turns out is not so smooth anymore, there is going to be a lot that could affect your real estate portfolio. And if you don't have one, now is probably the perfect time to get one started. For anyone that's new to real estate investing or just trying to refine your approach, the current climate is definitely going to feel like a roller coaster. But don't worry, this doesn't mean you should panic or do anything rash. It's about understanding the forces at play and positioning yourself ahead of the opportunities that are going to come your way. Let's start with the Intelligent Investor Framework. It's a game-changing approach that's been refined over decades to help investors make more informed decisions no matter the market, economics, or environment. I've personally used the framework to position myself for long-term growth, and in this video, I'm going to break it all down for you step by step. First, let's obviously talk about the stock market. It's March, it's off to a rocky start, and it's not going to get smoother anytime soon. The reality is, most everyday investors don't fully grasp how to maximize their returns. They might achieve returns slightly above inflation, but that's just scratching the surface. And we see volatility throughout the market that investors have zero control over. A study by Business Insider revealed how many investors miss out on the best performing days, often because they get spooked by market fluctuations and sell off their assets before the real gains happen. So if you're planning to build wealth over time, you're going to need a long-term strategy that comes with long-term vision. And the market's been strong for the past decade, but the outlook for 2025 is definitely mixed. Some analysts predict the S&P 500 will rise further, while others are cautious due to new tariffs and growing debt. The oil markets continue to decline and will probably likely do so because of Trump's open policy about drill baby drill. I mean, let's just be honest. The more wells there are, the more product there is available to market, the lower the costs are going to be. This current situation might signal a market correction or even a bubble. It'll definitely signify lower prices on getting product to market as fuel prices continue to drop. But what does this mean for you? If you can stay disciplined and dollar cost average your investments in the stock market and stick with your plan, then there's a good chance you'll come out ahead in the long run. You got to stay in the game, and you got to keep investing consistently. And if that's your course of action, maybe the stock market is something you want to take advantage of. But let's focus to real estate. That's something I know a lot more about, having spent 30 years in the industry. And for years now, the housing market has been dominated by high prices, low inventory, and lower mortgage interest rates. But over the last 24 months, we have seen mortgage interest rates rise. This has been a clear sign that things are going to change. What you could have bought in 2019 with 10 to 20% down is now substantially lower in price because of the inverse correlation between cap rates and mortgage rates. And what I mean by that for the beginners is, as mortgage rates rise, cap rates also rise. And when a cap rate rises, that means a lower sales price for the asset. So assets that were selling for $80 million in 2023 are now probably bargain priced at about $70 million. Why? Because of the cash flow. The less cash flow you have to cover the mortgage payment and return money to the investors, the lower the value. And there's a problem with that. The banks want to see you have 1.25 DSCR. That's your debt service coverage ratio. That needs to be 125% of the mortgage. Well, at 3%, your mortgage payment was $10,000, and that DSCR allowed you to have about $12,500 in monthly income and get a bank loan. But now the same purchase price is going to produce a $15,000 mortgage payment, meaning you're either going to have to buy it for less or bring in more capital. This is where there's been a standoff between buyers and sellers. Sellers want yesterday's prices. Buyers want cash flow. So until those get in alignment, we've been seeing a rocky market, but we've seen a lot of price adjustment. What I have been doing is bringing more equity to the table to take down these deals, knowing that we have already seen signals from Jay Powell and the Fed that we're going to see interest rates decline as the year goes on, which means, depending on how steep the decline is, I will be in a position to refinance, get some of my cash out in the next 24 months, and be into the property at a lower price point, because, like we just discussed, when interest rates come down, so do cap rates. When cap rates come down, purchase prices are higher. We're also seeing home prices starting to cool and inventory beginning to build, but not to anything that is detrimental to the market. And there's been a push to reduce the regulatory costs from the White House, which will definitely affect new home construction from timeline and costs. Trump's recent executive order aims to lower that home building costs by reducing some of the red tape, but we're also going to need to be cautious about the side effects of tariffs. What could raise the cost of lumber, steel, things like that will affect the bottom line of the prices. Now, for those of you that don't know, the whole goal of the tariffs is to bring those jobs of creating those products back to the United States. And again, supply and demand has the same effect on wages as it does on property. So the more we see those jobs come back to the US, the more we're going to see wages increase. The more you make, the more you can afford to pay for housing. This is what the long-term goal of the tariffs are. See, the U.S. is still facing a bit of a housing shortage, but it's also facing a shortage of qualified buyers, and that's been leading to the slowdown. But that means if you're looking to build or invest, you need to be aware of how long it takes for the prices to come back down to a level that makes sense for the investor. That's where the buyers and the sellers have to meet in the middle somewhere, and we're seeing prices tick down in the short term. In the meantime, look for opportunities to improve your existing properties and create value through lower management costs and higher rents. Because as housing prices stay high, the delta between what you can rent and what you can buy for is still large enough that it makes sense for people to be in the rental market, not in the home purchase market, which means we're still seeing a strong rental market. So when you're looking at all this, kind of to recap, if you were buying a multifamily asset in 2022, you could have expected to give a 3.5 to a 4.5 cap on the existing cash flow. That cash flow may or may not have changed in the last 2.5 years. If it has, the value has come up. But the cap rate has also increased to between 5 and 6% on the cap rate side, which allows for that purchase price to be reduced. So that is where the value is being created. If you can raise the additional capital that's necessary to get a great DSCR, you're going to be in a position that when cap rates come back down because interest rates came back down, you're going to be able to refinance, take cash out, and have a value proposition on your purchase price. This is the inverse part of what real estate investing is, but I want to bring in Warren Buffett saying that you buy when there's blood in the streets. And you do this because when purchase prices are coming down and interest rates are high, you're going to see that change over time, and that's going to create a value for you because when cap rates come back down, your property value is going to go back up, allowing you to borrow more against it and lock in that interest rate for 25 years, which is very, very normal for multifamily. So the bottom line is that we're in the middle of an era where real estate is really being influenced by larger economic forces like tariffs, political shifts, and even technological advances like cryptocurrencies that are changing the landscape. And as an investor, you need to stay informed, stay flexible, and have a strategy that can weather these changes. Finally, let's talk about cryptocurrency. Trump in the White House has really taken a pro cryptocurrency approach. And while we're seeing things happen with Ripple, we're seeing things happen with Bitcoin as far as a strategic reserve, these will have monumental effects on how wealth is created. So don't ignore this portion of the market. We've seen the SEC has recently come out and said, we're dropping our suit against Ripple. Ripple has said, we're dropping our cross suit. All of this is being done, putting them in the clear to become part of the ledger that's necessary for transactions to be done on large scale. And so for the investor, this definitely means new opportunities to diversify your portfolio, especially with Bitcoin ETFs and others that are coming to market. We'll be adding this to our investment portfolio this year as well, so keep an eye on that. In recap, 2025 is going to be a year full of surprises, but more importantly, it's going to be a year full of potential. And if you're new to investing or you've been in the game for a while, now is the time to refine your strategies, stay diversified, look for long-term growth, and understand the broader market shifts that are happening right now. I'll be back soon with more insight, so hit the like button and subscribe, and feel free to share your thoughts and your questions in the comments below, because I read every comment and love hearing from you. Until next time, take care and keep building your future the right way.